Scott, I think we can start.
Okay. Thank you, everybody. Very much appreciate you joining. My name is Scott Callon. I'm chairman of Ichigo. I'm joined by Dan Morisaku, who just said, Scott, I think we can start. Dan is the senior member of our finance department and head of our global IR. I'm working off of the FY22 so the February and fiscal year, so it ends next month. Q3 corporate presentation, which is right in front of you and is also available on our website. So let's get started. And again, we're grateful for you joining us. It's an incredible, difficult time in the world. We hope you're all okay. Let's start on page 8. So the broad summary, of course, is we're still operating under COVID, which has been devastating for the world and really hard on us. In that context, I mean, it's very much the case that how we are operating is dependent on COVID. Japan effectively defeated COVID as of September, and now with Omicron surging, literally cases are up 50-fold in the last couple of weeks off of a very low base. Well, kind of all bets are off as to where we go from here. But in the context of the world not ending because of COVID, if we work off of that assumption, it appears that we've hit bottom, and we're in the midst of a broad set of recovery. Certainly in the real estate market, it says prices of many assets are recovering, and recovered is probably the right word, and I'll go into that more detail. But we're very comfortable. We're going to have a strong fourth quarter. We were going to have a bigger Q3. This quarter was very light because one large transaction, the client decided to push it into the end of this month. So a whole bunch of stuff is going to happen in the current quarter, which is we're in right now. There's been some recovery in domestic travel demand, but not nearly enough to really drive anything interesting in terms of economics from our hotels. And full recovery, unfortunately, including inbound, which is going to be important to us, is going to take some time. I mean, the good news is the clean energy business is kind of COVID is totally irrelevant to it. It continues to grow well. We've had 6 new plants brought online this year, 1 wind plant, our first one, 5 solar power plants, power generation revenue up 10% year on year. We've launched a new business within Ichigo Owners, which I'll describe and which we think is really interesting and will be a growth driver going forward. And we continue to execute on sustainability. We awarded the highest leadership level in the CDP climate change assessment, and we're growing our ESG financing very rapidly. And I'll explain to you why that's important. Turn to the next page, page 10. I'm sorry, next page, page 9. We still, this is a durable earnings model. We unfortunately went to the wall, nearly to the wall during the global financial crisis, and learned from that we need to make sure we run a business which is structurally profitable. So despite all of the heavy downward pressure on earnings from COVID, we continue to run with stock earnings, so effectively kind of our fixed earnings at double fixed expenses, 191%. You can see on the right side of the page that sustainable real estate stock earnings and that has fallen by 11%, but we've got growth of 15% in asset management and 10% in clean energy. So that all sums together because sustainable real estate is so important to us, to a minus 2% decrease in stock earnings. You'll see there's been a shift in the composition of earnings as sustainable real estate is coming and asset management is rebounding and clean energy continues to grow. So clean energy at this point is actually 31% of our total stock earnings. Next page, page 10. Ugly numbers in terms of OP and net income. You can see the cash EPS, however, is dramatically different. As you know, over a multi-year period, we've shifted towards focused on as much as possible generating cash earnings. And that's important because Japan has high tax rates, so it's useful to use the tax shield. Much of this is coming through depreciation allowances, which are aggressive from a tax perspective, meaning they're higher than actual true accounting economic depreciation. But anyway, so the headline numbers are ugly. We fully expect to have a huge fourth quarter, and we will come in above last year, and we're on track on our full year forecast. Turning to page 11, the segment details. So we've got an increase in asset management. As you can see, 19% on the OP line down on the table, which is both an increase in base AM fees, asset management fees off of Ichigo Office and Ichigo Hotel. Sustainable real estate, the stock earnings, so this is rental income, is down. Both on the page right there is downtime at re-tenanting, which is true. The major impact on our stock earnings, we've had very, very little impact in our small and mid-sized office, which are our core kind of bread and butter in the office sector. We have had a completely different experience in our one large office asset, which is called Tradopia Odaiba. Large office buildings have been a little bit of a train wreck, and we're now re-tenanting it. So there's some loss of income on that. And the other element that is pushing down our stock earnings is actually hotels, which at this point have not recovered really at all. A robustly profitable asset class for us pre-COVID, which is currently earning nothing. In terms of flow earnings, the market has come back for almost, it's come back in every asset category, and we're actively marketing assets. And again, expect we're going to have a strong Q4. I touched already on clean energy, which we've got 6 new plants online through Q3, another 3 that have actually come online already in Q4. But anyway, as of Q3, operating profit, clean energy is up 12% year on year. Next page. So just looking at the COVID impacts, the earnings on the top of the page, it said low. That's true for office. The one exception is, again, we have a single large office, which has had a very different impact. And it's, you know, we can talk about it in more detail if you want a QA on that. But small and mid-sized office have been extraordinarily robust. Really no impact to speak of on earnings from COVID. No visibility in terms of impact from it, and the big offices are just a massive exception, and that's across the entire market, and we notice that in the single large office asset that we have. Hotel, the stock earnings impact has been devastating. There's very little going on in hotels in Japan and across the world. Retail impact has actually been low because there's a mix of, as an asset class, you've got kind of central business district, kind of, you know, restaurants, et cetera, in the retail space, which have been devastated, but they've been offset by categories such as suburban locations, drugstores, supermarkets are doing really well. So across the entire portfolio that we have, the impact has been low. There's been no impact on residential. There's been no impact on clean energy. In terms of flow earnings, the circles indicate, you know, where changes have occurred. And so as of Q2, you know, this impacts us, meaning our core business is we buy assets, we improve them, we sell them at a higher value because they're more valuable, they're improved assets. So as of Q2, offices and retail had come back in terms of investor demand for these assets if they're good. And this quarter, it's become clear that, you know, it is asset dependent, but there is, I'm sorry, it is investor dependent, but there is emerging demand for hotels again. And that's, so buyers want to buy hotels, even though the market hasn't returned. And I think that's a function of 2 things. Some of the buyers are correctly, you know, thinking that at some point COVID ends, hopefully correctly, and we go back to some version of the past. Although in our view, it's probably safe to underwrite for decreased business travel. And in our assets, which are, you know, of course, we're located entirely in Japan. And so we're very leveraged to inbound activity. So as Asia continues to grow and become wealthier and discretionary income grows faster than GDP, you know, there is leveraged growth to GDP in Asia, in the Japanese hotel sector. So, you know, the ability to underwrite over a multi-year period to growth in hotels is not unreasonable. And it is also the case that we've got a little bit of pull out of supply in the hotel space. And so we do have investors who are underwriting to, we think things rebound. And so that's one source of driving demand, investor demand to buy hotel assets. The other one is that residential, logistics, and office assets are performed really, really well. And so their prices are high. And so you have some shift in investor demand away from those assets towards hotels because they offer kind of a higher cap rate for investors who are looking for a return. Turning to page 14, and I'll go through quickly. I think I'm probably already speaking quickly. I won't speak any quicker than this. Page 14, this is kind of, we step through kind of the elements of the business model. We have stock and flow earnings, and I talk about this every quarter, so I'll just kind of run forward. I talk about it every quarter because it's a fundamental element of the business model. You get the stock earnings, which protect your downside and give you stability in earnings. You get flow earnings, which your upside, as you can see, we've had a COVID impact, which is overwhelmingly on the flow side. And as we, at some point when we normalize, we'll get the flow earnings back and more. Page 15 shows stock earnings. It's actually the first time we've broken it out through the categories in this way. So the clear, obvious element here is that clean energy continues to grow and will grow very strongly, we think, into the future. There's been a big drop off in sustainable real estate, which is primarily, as I said, decreased in hotel rental income and decreased in office income from our big office asset. Page 16. Again, one element of this business is that we have an embedded forward earnings. This shows the appraisal value based on realized gains. So the appraisers are not us. These are third-party appraisers that look at our balance sheet. They see all these unrealized gains. We'll get an end-of-year appraisal in a couple months. We expect this to be stable or possibly even go up because the assets are performing robustly. Page 17 shows that not only do we have significant appraisal value based on realized gains, but when we actually sell assets, we come in significantly higher than that. And so 1.5x is what we're seeing this year. The number is this low, and the multiple relative to the appraisal value based on realized gains is lower this year because we've primarily done sales in our Ichigo Owners business, which is a higher turnover. I'm sorry, we've primarily done sales this year, and we basically got rid of some assets that we didn't want to have and sold them at above appraisal value, and we're happy with that. But in the last couple of years, it's been a shift towards owners, which is a higher turnover business and has lower gross margin to us in return, providing very good value to our investors. We think over time we end up going back to something like a 2x to 3x in terms of the multiple lift relative to what the implied third-party appraisers say are the unrealized gains in our balance sheet. Page 18, again, we're focused on economic operating cash flow and maximizing it. So year in and year out, you see us generating significantly greater economic operating cash flow than our stated accounting-based net income. Page 19, no real change in our financial base, meaning it's continues to be very robust. We fund extraordinarily cheaply. There's been some drop off in the remaining loan maturity. As you can see, it's 6.7 years at this point. That's largely because we've been increasing our Ichigo Owners activity, and the average hold for an Ichigo Owners asset is about 8 months. And so we're borrowing kind of more typically 5, 6, and 7 years to give us a buffer on, we can hold this thing for longer. We don't really need to hold finance for 10 years for an asset that we're going to hold for 8 months. So there's been some push down on that, and that's purely a phenomenon of having more liquid, substantially more liquid assets. Turning to sustainability, we continue to push very hard because this is something we believe in. So we've accelerated our RE100 target, which is 100% renewable energy. Electricity is actually the definition that's used here. I mean, these office assets is almost entire electricity. But anyway, to 2025, To be clear, this is about not how much renewable energy we produce, where we produce massively more renewable energy than we consume. It's actually keeping all our clean energy assets aside and asking what percentage of your renewable energy that you're purchasing is going to be renewable, and we're going to go 100% by 2025. Next page shows that we're going to get there a lot faster on Ichigo Office. So that's going to be the first Ichigo entity that cuts over 100% of renewable energy, and that's going to happen by April. Page 23 shows the result for this year for the CDP climate change assessment. We did very well, as we should. I mean, it's an A-, and we were penalized for the exact phenomenon that I just described, which is like, wait a minute, you're not consuming as much renewable energy as we want you to, and it's not part of the thinking that energy consumers will also be massive energy producers. So in the CDP rules and in the RE100 rules, we get no credit at all for being a massive renewable energy producer. But anyway, be that as it may, we still scored with an A-, which puts us in a leadership category globally in the top 13% of all companies that are within the CDP process. And as you can imagine, companies that go through the CDP process are companies that really care about sustainability. So I am incredibly proud of the fact that we're being recognized for being truly world-class in what we're doing on sustainability. And it's accurate, and it's good for the world. It's what we should be doing, and we're going to continue to push hard on it. Page 24 shows one direct financial impact of this. And to be clear, we operate to be good for the world, not because it's the right way, because it's about profitability. We operate to be good for the world because it's the right thing to do. But one of the elements that's been very, very powerful about doing more on ESG is, and it's a good thing, financial institutions have become much more sensitive. And Japanese financial institutions very rapidly towards who are the borrowers and are they doing the right thing for the planet and for society. And so it's probably easier, so we've done a bunch of stuff on ESG. It's probably easier to look at the next page, which shows, so page 25, we've increased ESG loans 8x in the last 2 years. They're now about 20%, 17% of our total loan portfolio. The reason why this is really meaningful is, one, it's fundamentally correct in terms of doing the right thing for the world, and it's important that we as operators and lenders are sensitive to what we're doing and whether or not it's the right thing for the planet and for society. But it's also the case that these loans have incredibly attractive terms. So by switching to ESG loans, we're getting a brand new set of lenders. So because there's a strong desire right now on the part of financial institutions in Japan to demonstrate the bona fides that they're doing the right thing for the planet and that they care about ESG. We have, and we're very good at ESG, we have lenders who are actively seeking borrowers like ourselves. And so this process has brought us into a whole net new set of lenders. So it has diversified our lender portfolio. These loans come with no amortization, which of course it means, the effective duration of a loan is shorter depending on how much amortization is. And in real estate loans, you always have amortization. These loans don't. In many cases, they're uncollateralized. And there are no restrictions on the use of proceeds. They're not tied to specific real estate assets. So these are phenomenally good loans. So I pointed on earlier on the page, not a fundamental change in our financial position that probably underestimates what's happening right now. We are increasingly, a very attractive borrower for a broad range of financial institutions, and we can use this really well on behalf of our shareholders. One of the things about Japan is we all know it's a low growth economy and a mature economy, and so it's harder to drive top line growth. It's also the case that it's the single best place in the world to be a borrower. You can borrow effectively infinite amounts of money for nearly free. And so this is an extension of that. So there's been a very, very powerful and positive transition during the COVID period towards ESG, and we fully expect to be monetizing it for all of you going forward. Turning to page 27, it shows what's going on in terms of buy and sell activity. We continue to be selective in acquisitions and sales. This has always been the case. I don't think that title has changed for a couple of years at this point. Net buyers in the first 3 quarters by just actually that's a wrong number. It says net acquisitions of 1.3 billion yen. It should be 13.3 billion yen. But we're going to push all of that out the door. As you can see, Q3 sales have just been 12.4 billion, but we have a 17.7 billion sale to a domestic institutional investor, which will close actually this month. So kind of pretty balanced in terms of buying and selling activity year to date. Page 28, Ichigo Owners, which is a relatively new business for us, continues to drive long-term growth. And again, this is a very high turnover, low margin to us, therefore great product for the client. So typically we will have margins, gross margins order of something like 25 to 30%, and a longer term sustainable kind of mixed asset sustainable real estate business. This is more like a 10 to 15% gross margin, but with a turnover of literally 8 months on average. And so you're able to generate kind of ROEs sort of 30, 40, 50%. We just did a Japanese language earnings call a little while ago, and an analyst asked, appropriate question, why aren't you growing it faster? And there is a little bit of, and the answer is, yes, completely agree, and we're going to grow it. There was a little bit of kind of continuing in COVID with a very kind of Japanese regulatory environment, which requires a lot of face-to-face interaction to buy and sell activity. It's just part of the regular structure that they operate. And it's been a very, very difficult execution period for our owners team, which is only a little bit above 10 people. But this is a phenomenal business, and I'm going to talk about it a little more, but we are growing it, and we will, and you should expect substantial growth going forward. So at this point, we're kind of running at turnover. It looks about kind of less than 30 billion a year. The key question is how quickly we get to 40 billion to 50 billion yen per year. And so that's kind of billions of yen, kind of order of magnitude, kind of $300, $400 million a year turnover and more going forward. Page 29 shows one example of a new business that we've put into Owners. So Owners has been, and I'll put that on the next page, but to talk about kind of our asset management business, it's primarily been us working through our public REITs. And so you own a share on a REIT, and we work hard for you, and we deliver a high return. And typically at this point, it's about 5% yield on our Ichigo office asset, and on Ichigo Green, our solar power producer. The hotel yield has been pushed down, but it's also kind of typically 5 to 6%. The issue with owning a REIT is it's effectively a share ownership. It doesn't give you depreciation, which have significant tax benefits. It's not as conducive for doing estate planning. So we wanted to have a small lot, kind of small investment lot product for investors that would be an alternative to the REIT. It would give actual genuine full ownership to our investor client, and the advantages, the tax advantages, and the estate planning advantages of that. So this is what this new co-ownership business is. And we did a first asset sale in Meguro in central Tokyo. And so this is just brand new, right? And started the asset management in December. Today, we're starting the second transaction, again, in Meguro in central Tokyo. But we think this is going to be a really nice business. Probably the right way to look at it is on the next page, where we kind of parse out for Owners kind of how these different businesses work. So Owners has classically been the top two. We do residential asset sales, so super prime assets, brand new, high quality, central Tokyo, residential. and it's either the top, so we just get the gains on sale, or it's the residential asset sale, and then we'll do the asset management for the owner. And then the new co-ownership business is an extension of that. It really changes. It's similar to residential asset sales plus asset management, but it is small lot focused for individual investors rather than institutional investors. And our at this point, the asset management period is 12 years for the first two co-ownership assets, and we think it's going to be 10 plus years going forward. So this will be a strong, durable earnings stream. Look, we're really good at this, at managing real estate assets and growing value for them. There is a huge need. It's true globally, but particularly in Japan, for an honest return on one's savings. Real estate, high quality real estate, is a compelling value, and we're excited about growing this business. For at this point, we've been primarily serving institutional investors, high net worth. This expands the product category to kind of, people like us. So we're happy to do that. Page 31 shows what's going on in the for Ichigo Reits, to Ichigo Reits and Ichigo Green. And this has been a particularly challenging operating environment for the hotels, so we've been doing more there. You can see in terms of the Ichigo growth support there, we provided subordinated debt so that the investors know that we're there, and we're a firewall between them and anything going wrong. We've also taken down the operator risk, so kind of effectively credit risk on weak operators by transferring the assets management, the operator contracts, to Hakata Hotels, which is one of our subsidiaries. Turning to the next page, clean energy continues to grow very, very rapidly. And what's not on the page is, you can see on the upper right-hand side, we've got a pipeline, which has got 28% growth. What's not on here is, and so pipeline is, actually contracts in place for us to build and operate. There's been substantial change in Japan's attitude, similar, to what I spoke about with respect to financial institutions, and with respect to sustainability and ESG. There is a massive push on the part of the Japanese government for us to transition to renewable energy. And what's happening right now that we're very excited about is we have been limiting our growth. Actually, we've been limiting our growth in this business. There was actually a COVID reason, which was, the rural areas where you would primarily going to be putting up these solar and wind power plants have had much less COVID than the metropolitan areas. And so in the last year and a half, we have teams that go out and meet with representatives in local communities and talk about kind of, this is what our track record is, and this is how we would work with you, and to set up a renewable power plant, and go through all the zoning and the environmental issues, and no one wanted us to visit. So we've had this problem of the sales, kind of the acquisition process for new assets has been severely hampered by COVID. Anyway, so at some point that will presumably go away. But during this period, the Japanese government has pushed harder on making kind of expansion possible. So the other neck that we had, the bottleneck that we had in terms of growing our renewable energy business, has been access to the grid. And so there's been this policy change underway that's going to give renewable energy producers substantially better access to the grid. We think this is really, and this doesn't happen in the next 6 months, but it's a process underway, and it's going to happen within 12 to 24 months. There's going to be areas where we think there are very interesting opportunities to put up new plants that are going to become available to us. So that will be a growth driver going forward. We fully expect this business will be at least double what it is today over the next kind of 5 years. Turning to the next page, stock buybacks. It's something we believe in. We didn't make an announcement today. Sorry about that. This question was raised also in the Japanese analyst meeting. Hasagawa-san, our CEO, who took the question, is, talked about, we're looking carefully at that cash levels. I mean, at the end of the day, we do think the stock is cheap. We try to stay in our lane with respect to what we say and what we don't say. It's very, very difficult to talk about the share buyback issue. We didn't make an announcement. You should interpret the mean that we have uses of cash that we're looking at very carefully. But we do think the stock is cheap, and you should fully expect us to be back in the market buying our shares at some point. And finally, we continue to have our J-League shareholder program. One of the things that we made a decision over in the last couple of years that have had severe COVID impacts is, one, to do more in hotels, which have had very powerful economics and will at some point again, but have been devastated by COVID. The sports as a growth industry, we continue to believe is really true, but this has also been something that has had severe COVID impacts. But anyway, we continue to offer a J-League shareholder program to all of our shareholders, not only in this company, Ichigo Inc. 2337, but also our two Reits and Ichigo Green, the solar power producer. So those are my prepared remarks, as it were. I'm happy to turn to question and answer. So if you're on a Zoom, you can raise your hand via the app or the browser. And there's probably also a process. I don't know that there are very many people on the phone, but there's theoretically a process. You enter *9 to ask a question and *6 to unmute for that. But I suspect almost everybody's going to be on the app or browser. Anyway, again, thank you very much for your time, and I'm happy to take any and all questions or comments.
Hi, Scott. This is Greg at Point72. Can you hear me?
Greg, I can hear you. Thank you so much.
Great. Two questions, please. The first one is regarding your comment on real estate transaction and the fact that you were seeing some inquiries returning for hotels.
Yeah.
Wondering if you could develop on that. That was my first question.
And Greg, let me ask you about that. When we say develop, what specifically should I answer for you?
Well, are we talking already about very concrete kind of proposals, or are we just people having more the phone ringing a bit more, if you will?
No, okay, so I'll answer that question. Thank you for clarifying. Go ahead and tell me what your second one is, and I'll answer both of them.
And the second question is regarding the Ichigo Corners program. What kind of yield you are targeting for this type of 10 year, 12 years investment for the investors?
And I'm sorry, Greg, I dropped the central word. Did you say what sort of yield did you say?
What is the kind of all-in yield you are hoping to offer for this kind of
for the investors?
Yes.
I'm sure. Okay. So on hotels, look, this is very country. You'll see some hotel sales from us. Because Omicron has exploded again. I mean, there's always a possibility that we could see a retreat from hotels, but there are transactions that are kind of gonna happen, and that reflects, as I said, I think two things. One, investors taking a long view on Japanese hospitality as a growth industry, and they want to be involved, or two, they see the very high prices for not unreasonable prices, but the resi prices are up, office prices are up. There continues to be this absolute hunger for yield. Demand for real estate appears to be not only constant, but growing. And so if you don't feel comfortable buying retail, and you don't feel comfortable buying hotels, and if you're worried about work from home and don't feel comfortable buying office, then, it's squeezed up prices of other assets. And so within that group, the most kind of impacted is hotels. And so they offer on a forward kind of normalized basis, substantially higher yields than the other assets. So it appears to be that people are making choices like that. And, from our perspective, we have managed our portfolio to no more than 25 of the assets being hotels, because even though they're extremely high, very profitable. And to step back just to explain that, it's both clearly a growth industry. It's also the case that it's operational. And the execution for hotel operators has been not world-class like it is, for example, in Japanese restaurants and other parts of the hospitality sector. So there's an opportunity for us to earn, we think, very good returns there. But it's a very difficult environment. So if folks want to buy our hotels, and the ones that we think kind of would be non-core for us, we're happy to sell to them at these prices. So you'll see some hotel transactions. In terms of the co-owner business, these are actually, low yields to the final investor, in part because that's where the pricing is these days. But, something that looks like the high 2s to the low 3s would be where kind of the yield is. And you get, on top of that, you get a tax benefit and you get some advantage in terms of estate planning. But that's where that market is currently being priced.
I see. So all in, including the tax benefit from depreciation, we're talking maybe like 4% all in, that kind of thing, you would think?
That may be a little high, but yeah. So again, these are super prime, so it's probably not surprising that that these assets are trading at those levels. But yeah, that's where they are.
And this is always new properties from here on. You
Yes.
Build, develop, and sell. Okay. Understood.
Well, we actually don't build. So kind of the way that the business model works and why we're able to get good properties at good prices, just kind of state this quickly, is we will agree with the developer to buy the asset
Right.
in advance. So it's kind of 18 to 24 months in advance. They take all the construction risk on it. But in return for Ichigo being, so this is, tends to be small and mid-sized developers. Instead, we backstop the credit on this. It allows them to finance the building of the asset with a bank as a result, and then we lease it up. So those are the two kind of major activities that we take that would be a drivers of value. So we do leasing and we do the credit backstop. The other thing we do for our individual investors, it's primarily individual investors, is we're experts in real estate, and so they have Ichigo's effective guarantee on this is a good asset, and those are the sources of the margin, which is only about 10% on a gross margin basis, 10 to 15%. So this is a very, very high quality product, and we think there is. The market is pricing it too wide, at too high margins, and we can do this business and generate 30 to 40, 50% RE, and offer kind of this good quality value to our investors. So we expect to grow it quite a bit.
Understood. Thank you very much.
Thank you. Happy to take any questions or comments. Will. Go for it.
Okay, hi, Scott.
How you doing?
Okay, good. You can hear me. Yeah, thanks for the presentation. And I did listen to the Japanese, so some of this is affirming some of the information from there. Yeah. So the 17 billion, this is also a presentation, page 27, the comment about that sale was to close in Q4. And I think on the disclosure document, it said expected November 17th. So I had thought it would be in Q3, but obviously it was delayed. And that's fine. But the other comment was at 40 to 45 billion range was the expected asset sales value in Q4, and that many of those transactions were closing in January. This is all commentary made, in Japanese. So my question is, are there any sort of risks about further delays that we should think about, or is that 40 to 45 billion number a solid number?
It's solid. I mean, and that happens on occasion. But the investor that was going to do the 18 billion yen transaction in November pushed it back, and so I mean, we just pushed it back. Yeah, I mean, again, we've had a 50-fold increase in COVID in Tokyo in the last 2 weeks. So we should all be a little bit careful about kind of what happens from here. But we are highly confident this all gets done. And there, and there, the other transactions that we're highly confident get done too. So we expect to have a very strong fourth quarter.
Okay. And the commentary was that likely to exceed the bottom range and would still, I mean, the top range has not been changed. You haven't reduced it.
Yeah.
So is the top range still within reason, or is that a huge stretch?
Yeah, I don't think it happens. I mean, it's a range. If we thought it was out of the question, we would pull it down. But we end up somewhere in the middle.
Okay, thank you.
Yeah.
Next question. This was actually mentioned on the Ichigo Office REIT earnings call back in December. They mentioned they were pursuing or exploring the concept of bridge funds. And this is what GLP has done previously, and then now today in Japanese version, this was also mentioned as a potential strategy. So I think that's great news. Could you just sort of comment on that and what might unfold? Just any further color on that strategy?
Yeah, I mean, look, from ICH, we call this company Ichigo Inc. ICH. But anyway, from this company's perspective, we exist to serve shareholders. That includes not only our shareholders, but the REIT shareholders. And it's really important that you have strong governance around that, such that the REIT shareholders, genuinely benefit from any transaction that happens. The issue that the office REIT is having, I mean, the classic REIT issue is that when there's money available, you need to make sure the assets are there for you. And so it's very hard. And so money available typically, because they're asked to pay out their earnings, requires doing a public offering. And so it's actually important to do bridge funds to kind of align we now have money and we have an asset at the time that we want money, because in order to raise money, you also need to have assets. So bridge funds make sense from the perspective of a REIT. From our perspective, the asset management business is a non-asset business. So it has, effectively an infinite ROE to it. It's a good, strong business. We believe Japanese real estate offers strong value. And we believe that we have the capabilities to deliver that value truly in a world-class way for our REIT investors. So we'd like to do more there. And I think I said that the asset management business hasn't grown, and I own that. I mean, we avoided doing public offerings. We wanted to, as much as possible, to generate. We made a standard for any transaction that had to be accretive. We thought it was going to be the best way to get a premium valuation for our REITs, and it didn't work out that way. The REITs, over many years, people wanted to see more external growth, and so we're taking a hard look at it. Okay, then we should try bridging some assets into the REITs. Now, the other role that we're going to play is it's very competitive to buy office assets, and we can offer office assets to the REIT effectively at a discount to the market, because we get ongoing economics at a pretty good multiple for asset management on the REITs. So there's a little bit of the REIT kind of is leading it into us, unlike, because we have some assets, and everybody on our balance sheet, office assets, and can we please buy them? Can you put them into a bridge fund? So I think there's been a meeting of the minds on that, and you should expect to see something on this.
Okay. I've raised this issue before, and I kind of know what you're going to say, but I'm going to raise it again. I mean, your renewables fund share price is 4% below all-time highs. It's trading at a 1.6 price to book. It's 44% above the IPO price, and you're sitting on some. I mean, you're sitting on some assets that could very easily be put into that REIT, and I think a financing could be done very easily. So, considering things like, well, you didn't do a buyback, and I mean, the share price is, pretty weak recently. I mean, I hate to say that, I don't mean offense, but it's underperforming Mitsubishi Estate for the past 6 months, which, that's unlikely or uncharacteristic of Ichigo. So
Yeah.
I think, one of the things you might consider is perhaps, using a little bit, some of the other tools in your toolkit that you've kept, that you've not been using, because you obviously want to own these renewables assets. They're very valuable. I understand that, but at least signaling to the market their value through a PO, and making the REIT investors happy as well. There are a lot of possibilities, I think, that you might want to consider. So is your stance unchanged from the last time, that you're adamantly against selling them, or could there potentially be some flexibility in terms of your renewables fund going forward?
Well, okay. I mean, I'm a huge believer in flexibility. So yeah, are we flexible? Yes. I think our basic stance on Ichigo Green is that it's subscale, so you need to either grow it or roll it in. I thank you for your input. I'm not ignoring it. I genuinely agree with you. And to your very first point, it's not at all insulting to point out that our shares have underperformed. I am deeply and intimately aware of that, and want to fix it. So I appreciate your input and everybody's input on this. Always looking for good ideas, and I thank you for it.
Okay, I'll leave it there, and if need be, come back.
Okay, sounds good. Thank you all. Garrett, I think you're up. Are you there? Can you? I think we need you to unmute, or somebody needs to unmute you.
Got it. Can you hear me now?
Yeah. Thanks.
Great,
John.
great. Thank you. Just a question on the last conference call. Around that time, Japan Renewable Energy had been acquired.
Yeah.
For 200 billion yen.
Yeah.
And the report was they had 708 megawatts on an equity basis.
Yeah.
Of renewable energy assets, which comes to around 280 million yen per megawatt, which would imply for Ichigo's 170 megawatts, roughly a $48 billion comparable value. And you mentioned on that last call that, well, the fit, is a lot higher for Ichigo's assets. And there could be some other key differences in the quality of the energy, but that, you guys are still going to look into that comp and, see what it meant for the value of your assets. Do you have anything that you can add as to maybe what that implied as to the value of your assets, or any additional insight?
Yeah, wait, did you just say $4.8 billion US? I'm pretty sure
48 billion yen.
Yeah. Okay, I'm pretty sure that's what I said. So we're not off by an order of magnitude.
Yeah, that'd be great if it was US.
I think that number's still correct. I mean, one of the things that's happened, and forgive me if you're all aware of this, that has been explosive and powerful and fantastic for the world, for Japan, since that transaction, is that Mitsubishi Corp came in and absolutely clubbed the pricing of offshore wind, and taking it from kind of massively uneconomical to wow, these numbers are really, really interesting. Just to point that out, and the reason I pointed out and then to set it aside. The good news is it's not relevant to our assets, which, so you've probably seen Renova stock has gotten clubbed as a result, because they had a whole bunch of, they're going to do offshore wind priced in to their future value, and it's looking that game is completely changed. So Gary, yeah, we still think that our value is at least that, and for the reason, I mean, this is things are fluid in a positive sense, but because of the policy changes that appear to be underway in order to allow us to get better access to the grid, we think we're going to have more growth in the business. Now that's separate from what's the existing stock of assets, Garrett, that you just pointed to. But yeah, we think that's that value still very much holds up and is real. So, to Will's point earlier, we do think the stock is significantly undervalued. And we need, we obviously are motivated and need to take some action to address that.
Got it. Okay, thank you.
Thank you. Richard, I think you're next. You there?
Yes. Hi there. Hi, Scott.
Thank you, Richard. Thanks for joining.
Hi. Yeah. So, could you elaborate a little bit more on the hotel strategy? So, you mentioned that you're willing to sell some hotel assets if the price is right, but will there be a change to the strategy? So, you're obviously developing this Propera, which is asset light, but also you mentioned the operational gearing. Of the business, and that structurally or long term Japanese hotel assets are a growth business and potentially very good business, given the inefficiencies in the sector. So could you elaborate a little bit on how you envision the hotel strategy going forward with regards to business travel, boutique, and other areas you're focusing on?
Yeah. So look, I mean, I think this is pretty straightforward. So we try to be straightforward. We've got a portfolio of hotel assets. We have the Propera system, which is very powerful and non-asset, and we're expanding. And actually, one of the things is that we've been in a significant adding to the functionality of Propera, which is great. But like anything, we have a portfolio which has assets which we rank order everything, and so what's going to be sold in the hotel space are the assets that are the lowest priority assets for us, and we'll recycle that money into it certainly is going to go into things like Ichigoners. It's going to go into things like bridge funds for the Reits. It's going to go into growing our renewable energy business. So we're not abandoning hotels, but we try to be, if possible, sophisticated about kind of understanding where price and value is and responding to that. And the challenge with hotels has always been it prices daily, and that makes it the most economically sensitive. Turns out it's also the most pandemic sensitive of any real estate asset. So, at this point, the pandemic is not over. Folks are leaning into, we think it's going to rebound sometime soon. We have lots of hotel assets. We're happy to sell some of them to folks who want to buy them. So I think that's a fundamental stance. Does that make sense?
Yeah. So it's not so much a change in strategy. It's just selling some of the assets where you have less
that's right,
a less optimistic view on the return potential, and basically people coming in with the right pricing
with good pricing,
basically selling them.
We're going to sell assets, hotel assets, at above where we bought them several years ago, pre-pandemic. During the midst of a pandemic crisis where hotels are doing nothing. So we think we should probably do some of these sales.
And with regards to the competitive environment, so obviously it has been a tough 2 years. Initially, a few players stepped out, but have you seen further transactions or further reduction in competition, or is everybody still holding on? And have you seen anything there?
You mean in hotels, right?
Yes, in hotels.
Yeah, we're still seeing hotel operators kind of falling over. But the Japanese government has been good about trying to support service industries that are deeply affected by COVID. And so when we say falling over, there's probably been a couple % withdrawal supply, but not more than that, because the key mechanism that the Japanese government has done is it supported kind of individuals and restaurants in particular with subsidies. With hotels, it's generally been them asking banks for forbearance, and so don't pull in your loans and keep on lending. And so there's been lending programs to allow hotels which are underwater to stay alive. But it's been such an incredibly hard environment. Despite that, you've had weaker operators just kind of pull the plug. So there has been some withdrawal supply, but it's a few %, no more than that.
Okay. Maybe one final question on financing. So on slide 25, you pointed to the ESG finance support and that it's growing. So is it fair to assume that basically over time all your loans will roll into these ESG type loans?
We would love
that. And does that mean that you also have a lower financing cost going forward, or is it just the terms or some other features that are just beneficial?
The financing costs are roughly the same. It's the other elements though which are incredibly powerful. I mean, you know, I think the right way of thinking about it is these ESG loans have really no covenants to speak of. I mean, not only covenants, but you know that they you know, it really makes a difference. Is this, you have total flexibility to do whatever you want with the money, or do you have to do it, you know, with a certain asset or a certain category or a certain location? Is there amortization on it? You know, as I said, the effective duration of a loan is you probably know this, but you know, you're paying, typically in Japan, you'll pay, in our case, we'll pay 80 basis points for a loan, but we pay 3% principal per year. And with these loans, there's no amortization principal, so you just 80 basis points for the loan. So from a cash flow perspective, these are very, very powerful loan structures. So you know, our ambition is to grow. We've done an 8x in them over the last 2 years to grow as rapidly as we can.
Thank you.
Thank you. We got some more time. I mean, we're running out of time. You might want to, will you back? Sounds good. We'll go for it.
Okay, back for more.
Thank you.
Okay, there's 3 questions.
All right.
So on hotels,
yeah.
So the hotel Reits, Invincible and Japan Hotel REIT and Oedo Onsen, they publish their monthly data, and you know, at the end of the state of emergency, their October number improved from about 50 some odd to about 60% average occupancy. Then November again from about 60 to about 68. And so we track this utilization data, airport traffic utilization, NTT Docomo publishes, and it suggests that December is going to probably be better than November. So in that background, what in terms of your portfolio and your utilization, I mean, have you seen you know, since the state of emergencies ended, an improvement, or just give some background there if you could?
Yeah. So one of the things that's gone, and you're absolutely right, that occupancy has been healthier. Part of the reason for that, Will, though, is that people have cut the daily rate. So the problem is that the RevPARs has gotten pushed down really hard. And that's the smart and the right way to do it. And we've done that ourselves. Look, at this point, we actually have a few of our hotels outperforming pre-COVID right now, believe it or not. But you know, the exception that proves the rule, most of the hotels on a RevPAR basis are still down 60 to 70%. And you know, the problem is when you're down, you know, and at the bottom they were probably down 80%. And so when you go down from down 80% to down 60, that's from 20 to 40. That's a double, but it really means you're still down 60%. So the hotels are still deeply impacted. They just are. And part of it is because it's not just occupancy, it's that ADRs have dropped down so much in order to try to fill the hotels.
Thank you very much. Got it. And then this is specific to your sustainable real estate division. So you break it out between rent income and real estate sales. And just looking at the stock business, the rent side, looks like in Q1 is about 4 billion yen, and that dropped in Q2 about 200 million yen to 3.8 billion. So clearly deteriorating. I think this was Odaiba. I think this was hotels.
That's exactly right. It's primarily Odaiba, Will.
But then in Q3, we were back up to 3.9 billion. So about 100 million yen improvement. Can you elaborate on what might be happening there?
It's a guess, but I think it's actually some improvement in hotels. You know, this has been super volatile, as you know. We're both in Japan together. It's like, okay, the COVID's gone, no COVID's back. So the hotels have been showing some volatility.
Got it. Thank you. And then the final on the Odaiba, the Tradepia asset.
Yeah.
So this was
Yeah.
again from the Japanese, where
Yeah.
had leasing activity not been successful, it would have dropped about 40%, but you
Yeah.
picked up about 15% or so, and so it's rough closer to about 60% right now. And the anticipation, this is in your publication, of getting to 80% by the end of next year. Just can you give a little bit of color on, you know, who's coming, what the rent levels are versus pre-COVID, things like that, how that will stage out over the next year?
Yeah, I mean, rents are down about 10% in the Odaiba asset. So look, I'm actually quite positive on that asset. I mean, which is to say, it does have, and you were on the call, so you heard Hasegawa-san talk about the lower levels of the building.
Right.
And I don't know if he to be clear. So what's fantastic about the Odaiba asset, for those of you outside of Japan or outside of Tokyo who don't know the Odaiba area, it's right over Tokyo Bay, and it's beautiful. And unlike central Tokyo, where you have, which are like Manhattan, you know, the only views you have if you're facing over Grand Central in central Manhattan. But anyway, you know, central Tokyo really doesn't have views like this for the most part, and so the upper floors are fantastic. They're truly differentiated. We've actually had a systematic program on, let's get people who really care about the view and look over this phenomenal bay and the Rainbow Bridge and all this sort of thing. So it's the lower floors, which are slightly more challenged. But, you know, I know it's a super compelling value. We're filling at about 15,000 yen per tsubo. The peak was up to 17,000 yen. We underwrote it originally to like 13 to 14 to 15. So it's beating its business plan. There's no impairment risk on it. It's still massively above plan. And, you know, we're having to give free rent at this point, you know, typically 6 months, could be as much as a third of the rent period in order to get this thing filled. And then kind of moving is really expensive in Japan. So it tends to lock people in for many, many years. And so we think it makes sense to do that. But one of the things we haven't done is we haven't rushed to fill it, because we are confident. It's a really great asset. It was built, as you know, originally as a corporate headquarters for one of Japan's biggest trading companies, super high spec, beautiful. And, you know, we'll fill it over time. So yeah, it was actually going to go to 70% occupancy, and then COVID pushed it down to what was going to be 40. And as Will just pointed out, we expect to close this fiscal year. So this is only 2 months away, something like 50 to 60% occupancy, and push it up probably to 80 over the next year. But we think in the long run, the right thing to do is to fill it with the right tenants. And to answer your question, you know, it's all sorts of companies, you know, IT companies, growing companies. It's the biggest issue with filling it quickly is that when companies decide they want to move to Odaiba at a cheaper price from central Tokyo, I don't want to say the landlords are panicking, but I mean, the landlords are like panicking. Like, don't go, we'll cut our rents by 40%. So, you know, this is one of the issues. You need to be able to compete and have a differentiated offer. And so it's a little bit hard to compete if somebody in central Tokyo wants to cut their rent by 40%. Just to be clear, everyone, Odaiba is about 20 minutes out of central Tokyo. But it's a fabulous area. And yeah, I think we're going to fill it. And it's probably takes 18 months, but I think likely you'll see us running at, you know, near full occupancy by then. Great,
appreciate it, Scott.
Thank you. I think we're done. We've gone over time. Thank you, everybody. Appreciate you being with us. And again, I understand it's a really hard time in the world. Hope you and your family and friends are all safe. Take care. Be safe. Thanks so much for joining us today. We'll bring it to a close here.